Hi guys, Uncle Dan here, and I've just figured out what I'm doing with my money. I'm going to share it with you. I just spent a bit of time studying what the Fed meeting minutes showed us last week, and I'm planning for May 2nd and 3rd, which is their next meeting. Now remember, the Fed's mandate is full employment and keep inflation at 2%. So the problem they have today is inflation is too high. They have no control over oil or housing. The only thing they can do is control interest rates, and they do that two ways. Back in 2020, they dropped rates to zero, but they did not want to go to negative rates like Europe. So then they resorted to quantitative easing, which was purchasing bonds. They purchased a ton of bonds. Now they're getting ready to start running off the balance sheet. And so what we need to do is figure out, what do we do with our money? What do we do with bonds? What do you do with stocks? So I have a couple interesting pieces of data I want to share with you. First thing I want to talk to you about was the balance sheet. We had the financial crisis of 2008, and the Fed's balance sheet went from $1 trillion to $2 trillion. Now, these are bonds that the Fed purchases to put money in the market, which brings rates down on the long end. They've had a few attempts to running off or reducing the balance sheet, but when they reduce the balance sheet, rates rise. So that typically scares the market. If the market gets scared, then the Fed tends to reverse the selling of bonds. So what we saw in 2020, the Fed stepping in, having already dropped rates to zero, stepped in with quantitative easing and bought $3 trillion worth of bonds, moved us up into here. They tried a small runoff for a month, and the market got scared, and they turned around and started buying bonds again. Now we're up to almost $9 trillion. Imagine we've gone from $4 trillion to almost $9 trillion since the pandemic started. Now, what's the big number here is May 2nd and 3rd. It's the next Fed meeting, and they are going to start attempting to reduce the balance sheet to help bring inflation back down to 2%. They're going to try to raise rates to slow demand and bring inflation down. What's that going to do to our bonds and to our stocks? Let's take a look at what's happened so far. First, I want to take a look at the bond market. Now, here's TLT, which is the bond ETF. And one thing to notice here is that I've actually overlaid each of the meetings that the Fed has had since the pandemic started. They've been purchasing bonds the whole time. But in the middle of last year, they told the markets that come November, they were going to start reducing the amount of purchases, which is called tapering. It's not a runoff where they sell bonds. Come November, they've started to reduce the amount of bonds that they purchase. Now rates are definitely going up. They're going up because the Fed is not purchasing as many bonds. Now, what's interesting is come this May 2nd meeting, they told us last year when they started to taper that their intention was by May to start running off or reducing the balance sheet. This is definitely going to raise rates. So an interesting point I wrote down was there's a lot of talk about how long-term rates are lower than short-term rates, and this typically suggests a recession. But in this case, long-term rates have been kept low because of bond purchases. So we're going to see long-term rates go higher than short-term rates as the Fed starts to reduce the balance sheet. So don't worry about the inverted yield curve. That will not be there long. Question is, do we buy banks? Because once we get the long-term rates moving higher, banks can make more money. Now let's talk about what happens to stocks. This shows you what the triple Qs were doing. They were crashing in March of 2020 until the Fed stepped in with quantitative easing and started buying up all the bonds. So we've seen a huge rally since then. So basically, almost the whole way, they've been buying bonds. There was 1 month where they actually started to taper, but the market got a little nervous and they just decided to continue buying. What you can see here, every meeting they've agreed to purchase 120 billion in bonds. But come November, they started to taper. They started preparing us for the day when they start to run off bonds that are on the balance sheet. And that's the next meeting, May 2nd. And they're saying for the next 3 months, they're going to move towards reducing the balance sheet by around 90 billion a month. And then eventually package up and sell off all their mortgage-backed securities. Their long-term plan is not to hold any mortgage-backed securities. So rates are going up, my friend, like it or not. The only good news I can see in all of this is the Fed has a history of wimping out and jumping back in and buying bonds again. When we see a crash in the equity markets, the Fed is going to be very quick to flip around this intention of running off the balance sheet. Where we end up, nobody knows.